Good afternoon, everyone, and thank you for joining me for the Economic Update webinar. Hope everybody is enjoying the day and getting ready for a great weekend. I think we're going to get rain around here, so I don't know how much fun it'll be to be outside, but in any case, I hope you're enjoying today and looking forward to the weekend. And I really appreciate the opportunity to spend this time with you today. The economy has made some significant changes over the last year. And with the stimulus package, the market has continued to grow. And I've had a number of questions that have come up over the last few weeks about the expensive nature of the market, the valuations, whether or not it is sustainable, should we be anticipating a big correction? And I thought it would be just easy to address some of these questions using some of the economic data that we have in our at our disposal now, and to share this with you. So I'm looking forward to spending about an hour. I hope I can get through the presentation within the next 60 minutes or so. If I wrap up a little bit early, that'll be great. And let me know as we go along if you have any questions. There is no function right now to ask a question in the webinar, but feel free to send me an email, reach out to me or Chris, and we'll be happy to discuss any of the slides that we have in the presentation. Look forward to sharing those things with you. So the first thing, just basic disclosures, basically saying the things that we always say, which is past performance is no indication of future results. And of course, in this situation, the dynamic of the economy is changing continuously. So we may give an opinion today and have a different opinion tomorrow, but at least this will give you some perspective. And the past performance, of course, does not indicate any future results. So just bear that in mind as we're going through the presentation. So here are the three basic questions. And these questions have come up so frequently over the last few weeks. Many of our clients have, and either in our reviews or in emails or phone calls, have asked one or all three of these questions at one time or another. And the first one, of course, is the stock market overpriced, or is this a reasonable valuation for this particular market under the circumstances? With the coronavirus damaging the economy, so many people unemployed, how could the stock market keep rising and not being in a situation where it's overpriced? So that's the first question. The second question is, what's the outlook for the US economy over the short term and then maybe intermediate long term? And that ties right back into the stock market. Well, if we're struggling with high unemployment rates and things are not going well, then how in the world can we have an economy that's healthy? How does that play back into the stock market, and what should we look for US stocks? And then the last question that has come up very often is the question of inflation. So if the stock market is growing and asset prices are growing, should we expect inflation anytime soon? And that, along with the debt, that means that inflation rates could possibly go up. And we've actually seen some rising inflation rates over the last year or so. So what does that mean going forward? With all the new debt that the US government has taken on, should we expect rising inflation? Will that impact our economy and our portfolio? How will that play out over time? So I want to give you a snapshot on each of these particular items and give you a feel for what we would expect to happen in the economy and in the stock market in the near term. So James McIntosh laid it out very simply. If it looks like a bubble and it floats like a bubble, if it quacks like a duck, it's probably a duck. And in this particular case, it is a very confusing set of data that creates a little bit of contradiction with that sentiment. So if it looks like a bubble, maybe feels like a bubble, people are talking about the market being bubbly. I've seen our typical economists who are kind of the fearmonger economists coming out saying, look out, because we're getting ready to see a lot of trouble. Unfortunately, there are too many of those who try to make a reputation on that sort of thing. So I always discount that just a little bit. But is it bubbly? I mean, should we be concerned about the current prices? They're higher than they've ever been. You've heard all the records that we've broken. Anytime you see that, the first question that comes up is, are we in a bubble? Is this another bubble? Well, let's take a look at it and just decide for ourselves. When we look at the data, the stock market falls on a very consistent line. In fact, if you look at the book that was published by Jeremy Siegel back in 1994, the US stock market has grown with dividends at an annualized rate of about 10% since 1871. So annualized rate of 10% creates a curve on a graph like this one, where you see the curve wrapping up rapidly. It looks like it's growing faster in the end, but that's just the way compounding works. And so you look at the red line, which is prices plus dividends, and you see the performance of the US stock market. The black line is the growth without the dividends, so just the price and how that has grown. So the price alone has grown at 7.9%. You add in the dividends and you get this 10% growth rate. And the thing that you'll notice about this is that the line has wrapped around that growth rate. And for the most recent 10-year period, it's actually been below that trend line. So in other words, we've seen compounded performance below 10%, really basically for the last 10 years. And only now are we back above that trend line. I'll show you another example of this. This is a logarithmic scale, which just basically means that it's a percentage change. So the straight line gives you a little better perspective on what's actually happening. That's still the same 10% average growth rate. That's still the same 7.9% average price growth rate over that period since 1991. And this is the way the line portrays itself now. Well, I think there would be very few of us who would argue that the period that's in the circle was not a bubble. So that period in the late 1990s when .com was so popular, you could throw a dart at a dartboard and earn money on stocks, buy anything that was .com, and it would go up. And a lot of people did. And unfortunately, in about the end of 1999, it started to unravel and a lot of people lost a lot of money. But look how far above that trend line that period was in the late 1990s. It rose significantly above that 10% average trend line. And then it fell dramatically and got back to the trend line. And then if you look forward, you can see the period immediately following the decline. The red line is actually, and the black line are actually above their trend lines, and they're above their trend lines for about 5 years. So what that should imply is that being above the line is not necessarily a death knell that your portfolio is going to decline right away, because there are periods of time, both prior to 1999 and following that period in 1999, where the stock market can stay above that trend line for some time. So I know it must feel counterintuitive sometimes when we say we think the stock market is expensive and yet we don't pull the money out right away. Well, why is that? Well, the reason is because the stock market has its own mind about things. And even though it's above the trend line, it doesn't mean it won't stay there for some time. And we want to be a part of that if the market continues to grow, even if the valuations are high. So what do you do instead? You rebalance the portfolio. So you take assets that have grown just like we did back in the 1990s when Alan Greenspan was saying the market was irrationally exuberant. We still had US stocks. All we did was we took the US stocks and we rebalanced those, sold them when they went up, and bought the things that were less expensive. And those less expensive stocks were then the winners in the next period. And that's what we realized there. So project this out to 2021. And if you go all the way out to the end of the graph, you can see that we've just now really crossed over. And these returns are as of April 6th. We've really just crossed over this trend line. And both the price and the compounded version with dividends just over the trend line. So this implies to me that, yes, the market's a little expensive. It is above the trend line. So you really can't argue that it's not expensive. But the question is, how much more expensive is it? And is it sustainable? Or is it something that you would expect to immediately correct? Well, when Alan Greenspan made the comment about irrational exuberance, the trend line was above the returns were above the trend line at that time, but it took 4 years after he made the comment for the market to come back. So there's some potential here that if the earnings catch up, and there's some support for those earnings catching up, that maybe it's a little expensive now, but it's not so expensive that we should be fearful of a dramatic collapse because the market is above that trend line. So the next thing that I would like to share with you is where earnings are. Of course, earnings support the market performance, and without earnings, you can't see stock prices grow. So our concern has been over the last few years that we have seen prices growing faster than earnings. And whenever we talk about the term called valuation, we're essentially just talking about how much more expensive the price is than the underlying earnings of the company. So you can see from this graph that we saw a dramatic decline in earnings in 2020. Little surprise of that. A lot of companies went out of business. A lot of companies had to close their doors temporarily. So we saw a significant decline in earnings. But now we're starting to see this V-shaped recovery that we talked about before. With all the stimulus that the government has done and put into the system, we're starting to see recovery in the earnings as well. And you can see the projected earnings for 2021 are right near the trend line. And then by 2022, we're expecting the trend line, actually earnings to be right on the trend line, which is to me just remarkable given the fact that the market has declined the way that it has. So, so needless to say, we are expecting this portfolio earnings to get back to where they were before. And when you consider that below now, where we are right now, you're looking at an earnings picture that is destined to improve. And that's an important part. So if stock prices are high now and they remain where they are, but earnings improve, that means valuations come down. And if valuations come down, then that means that we're in a situation where the prices are sustainable, become more sustainable, and the upside potential for the performance is better as well. So again, this graph suggests that maybe it's a little bit expensive because earnings are depressed, and they have been and they will be for at least a couple of more years. But does it suggest that the stock prices are overvalued because earnings are depressed? Well, when earnings are expected to recover like the way they are on this graph, it's actually improving the valuation picture on the stock market year by year. So let's look just a little bit forward. So the first thing that I have suggested there is that we are above the trend line. It is a little bit expensive, but what's going on? What's the underlying factors and some of the things that we could expect to happen going forward? Right now, this is the picture of the S&P 500, essentially over the last 14 months or so. And this is the picture of the market declining rapidly when the pandemic hit the United States and closed the economy, and then starts to recover. But what's stimulating the recovery? And that's the important aspect of this. What is going on that would cause the stock market to rise so rapidly in the face of all that's going on economically that is, might be considered negative? Very simple. It's stimulus, and we've seen a lot of it lately. So you see here, down at the bottom, we saw the $2 trillion CARES Act that was released in March of last year. $2 trillion. We've never seen anything like that. Trillion is a gigantic number. We've never seen anything like that. And so that's dumped into the economy to try to support the economy. Then we see this $483 billion supplemental package that comes right on the heels of that, stimulates the market again. Go out a little bit further, we start to see the stimulus package was delayed here, and then all of a sudden the market reacted negatively. And then it kicked in December, $900 billion of additional stimulus. And what did the market do? It went up even more. And we started to see this over and over and over again. And I think it's a lesson from the Great Recession. I've heard more than one economist say that back in that time frame, when you did the postmortem, a lot of people felt like they didn't add enough money to the economy during that time frame, and they should have. Had they stimulated the economy, it might have helped the recession end sooner. So what are they doing now? They're throwing a ton of money at it. They're basically trying to make sure that there is enough economic infrastructure to allow the economy to recover and prevent economic scarring that they talk about. And so, so now we have all of this stimulus that has hit the market. And the question then comes up, well, what now? I mean, we've seen all of this stimulus. What's going to happen next? Well, the argument around that is what the Fed's committed to doing. And what we're seeing is a very accommodative Fed environment. And this graph is busy, but I'll simplify it for you. The red line represents the bond market. And when the line drops below zero, that means the yield curve is negative. And a negative yield curve basically means that high yield bonds, longer term bonds yields are lower than short term bond yields. You wouldn't expect that to be the case. If you're locking the money up for longer, you would expect the yields to be higher. But whenever the Fed raises interest rates, that causes the short-term yields to go up, and often that yield curve will invert. And that's a very good sign that you're expecting the economy to slow down. And you can see here back in 1989, the yield curve inverted. Well, by the middle of 1990, we were in recession. Go forward here, 2000, the yield curve inverted and we were in recession. 2007, your yield curve inverted. We were in recession by 2008. We had a number of very, very good examples where the Fed basically manufactured a recession to slow things down. And that keeps inflation at bay. That's been the mantra for years and years. 2019, the Fed inverted the yield curve slightly, but the recession that followed was as the result of the pandemic, and it was short. Now look what's happened. The Fed has turned completely around, and you can see the trajectory of this line. Not only is the yield curve not inverted, it's actually very, very sloped now, and probably very close to the average slope, which means the Fed is accommodative and committed to making sure the economy has everything it needs to get back to good footing and to continue to grow. So that's supportive of earnings, of course. And then, behind that, that's supportive of a strong stock market. So if you look forward, the Fed won't burst this bubble anytime soon. And that's basically just the Fed saying, we are committed to making sure we are at full employment. We go back to the employment levels that we were in 2019 before all this happened. We're not worried about inflation in the short term. We want to make sure that the economy is in good shape before we do anything that could possibly disrupt that. In fact, I'll even go one step further. And Jay Powell said that he's not concerned about PE ratios right now. So, we talk about price to earnings ratios all the time as a measure of valuation. Well, price to earnings ratio is a pretty good indication of how expensive a stock price is. And you have a number of different ways to slice and dice it, but a price to earnings ratio will give you some potential for what may happen in the future. Well, Jay Powell says, if you look at the current price to earnings ratio, it's sustainable. Well, why would that be? Well, because interest rates are so low and they're expected to stay that way. Back in December, we saw the 10-year Treasury bond at 0.93%. Now, the Treasury bonds have increased since then, but 0.93 is a very, very low rate. And even at 1.6 right now, 1.65, that rate is extremely low. So the Fed is anticipating that those rates will remain low, and that essentially results in a lower cost of capital for companies. What does that mean exactly? It's very simple. A company needs to borrow money to increase their research and development, to expand, to add plants, to grow, in an international setting, for example, and they borrow money to do that. Well, if the cost of capital, the cost of the money to borrow is low, that means they get a higher return on that capital. And as the result, you can justify a higher PE ratio. The question is, how much higher? No one can really define that. And that's a challenge to know, are we really high? Are we a little bit high? And that's the argument on the market right now. So the thing to realize, though, is if the Federal Reserve thinks that the PE ratios are reasonable, and that, as was paraphrased down here, stocks are not overpriced compared to bond yields, means that they're going to be committed to this for a sustained period. They're committed to making sure the environment is business friendly, earnings friendly, and therefore supportive of the current stock prices. So one of the best quotes of the pandemic, I think, is from Jay Powell just a couple of months back. And he said, we're not thinking about raising rates. We're not even thinking about raising rates. And he essentially says that's off the table until we get just a little closer to the employment rates that we had back in 2019. And we're a few million away from that now. So in order for us to get back, we have to see some pretty substantial growth. We're already seeing some, and we'll continue to see more, but the Fed is committed to making that environment healthy and making sure that we are in the position to do that. Now, the next thing that I want to share with you is about stock prices. And as you know, the prices have been going up dramatically. And the reflection of the S&P 500 is initially to say, aren't the prices high? Aren't we seeing prices that are unsustainable? Well, the answer to that question is a little bit and in certain places. And this is the point that I want to make about the market right now. While the stock prices of the S&P 500 have gone up significantly, it's not all of the stock prices of all of the companies. Now that sounds intuitive, maybe a surprise. Well, once I share with you what's going on in these graphs, it'll be even more evident what's happening across the market. So if you look, this graph on the left describes for you the PE ratio of the top 10 stocks in the S&P 500. So you're talking about the Googles and the Apples and the Microsofts and Amazon and Johnson & Johnson and Berkshire Hathaway and so forth, and those companies. And you want to know what valuations are like for the whole S&P 500, but look what has happened in just those top 10 stocks. So we've talked about this before. We've seen, what they call the stay-at-home trade. You see the companies that do well when the market is, when the economy is tied up at home. Microsoft is going to do great. Amazon is going to do great. So you're seeing that effect in these top 10 stocks. But look what has happened in the difference between the top 10 stocks now trading at a PE ratio of 31.6 versus all the other stocks in the system, the other 490 stocks, only trading at a PE ratio of 19.6, a significant discount. So when you look at the S&P 500 and it's been going up dramatically, you would look at it and say, gosh, it's expensive. But really the answer is there are a few stocks that are very expensive, and the rest of the market may be just a little more expensive than it has been historically. When you look at those relative averages, you see 162% of the top 10 stocks. That's the more expensive stocks is 162% of what it has been on average versus more in the 120% range for the other 490 stocks. Well, when you consider cost of capital, you might say, well, that's still expensive. It is expensive, except that when you consider cost of capital, those rates, those average rates, don't reflect interest rates that are historically low. And so when cost of capital is low, you can afford a little bit higher PE. And that's what's happening right now. It's happening in the bulk of the market. You're just seeing a little overpriced in this one small segment, the top companies. And the question, of course, is that sustainable? Is that going to correct? What are we seeing about that? And I'll address that question in a second. But the answer, at least in part, is those companies are doing great. I mean, what better company to be in than a company like Amazon or Microsoft when people are at home? And if they're like me, they're stuck at home and all they're doing is surfing Amazon to see if there's something they can buy. And so there's a lot of that going on. And I'll show you even more about that in a second. But if you look off to the right here, what you'll see is that the top 10 stocks earnings are at 28.3% of the total market capitalization. And that's the weight of the top 10 stocks. But the earnings is 20.8. So they're earning essentially what they are contributing. So even though they're 28% of the total S&P 500, the top 10 stocks account for almost 30% of the S&P 500, there are also almost 30% of the S&P 500 earnings. So the companies are doing especially well. So those ratios, you have to take them a bit with a grain of salt. In fact, for very high growth rate companies, those ratios may be perfectly reasonable. So let me show you an example of that. There's a ratio that is referred to as the PEG ratio. And you don't hear us talk about the PEG ratio very often, but the PEG ratio is basically the price to earnings, which is the first measure, but then divided again by the growth rate of that company. So in other words, a faster growing company can afford a higher price to earnings ratio. And so you can compare companies, how expensive they are relative to price and earnings, if you consider the growth rate too. And what you'll see is these fastest growing companies, Apple, Microsoft, Amazon, Google, those companies that are really, really growing fast, generating a lot of earnings, their growth rates help overcome some of the pricing. So you say, well, maybe the top 10 stocks are too expensive. We'll see a correction because of that. I'll say, wait just a second. If you look at these PEG ratios, you'll see that the lower the ratio, the less expensive the stock is relative to its peers. And so these more value-oriented stocks like the Johnson & Johnson, maybe JP Morgan, those companies that are down at the bottom, these stocks are trading at 3.5, 4.5 PEG ratio, which is, reasonable growth rate, but, just a modest growth rate, but a modest PE ratio. Then you get up to the top and you say, well, that's a high PE ratio. Well, wait a minute, these companies are growing at 20+% per year. They're growing their earnings at 20+% per year on average for the last 3 years. So if you look at the PEG ratio, that makes those companies actually look less expensive. So the point of the story is that the market looks high. Now you've gotten down to just a segment of that market that is really high, but even that segment with the current growth rates doesn't look unreasonable if you make the assumption that the growth rates are sustainable going forward. So there are some arguments that while the market looks a little uncomfortably high, you can make the argument that with the accommodative Fed and only slightly above the trend line for growth rates, prices concentrated in just a few stocks, and even those stocks have very high growth rates, we are in a position where the market seems more fairly priced than it may appear on the surface. And especially with earnings expected to continue to grow, the likelihood of seeing a massive decline seems to go down pretty significantly because of that relationship. I want to make one other point. Most people are not fearful of the 10% correction, at least most of our clients. 10% corrections happen on average once a year. So if you're not expecting a 10% correction, let me just hit the alarm clock and tell you, you should expect a 10% correction at any time. It's imminent. It's going to happen. You might as well just plan on a 10% correction at some point in the process. But most of our clients are fearful of the 20% decline or the 25% decline, or like last year, 30% decline. Can we do something to avoid that? I wanted to share with you when those declines most typically happen. And what people are fearful of are declines that really happen, number one, rarely, and number two, are almost always attached to recessionary periods. That's a very important perspective right now for a number of reasons. But first of all, we've already been through the recession. So we've had the decline, we've seen a recession, we're now in recovery. And when you track back to previous periods, you see these declines and you see those recessions precipitated very large declines in these periods. You know, there's the period in the 80s, and then you look here in the late 90s, and there's the 2000, and there's the Great Recession. And we saw a nice big decline last year and a very short recession last year. So the question is, what could possibly precipitate another recession in the near term? And there are unknowns, of course. We could see maybe an expansion, another wave of the coronavirus that catches us by surprise. Or maybe there's something out there that we're not expecting. A lot of people want to point to a bubble. There's a bubble, and that's going to precipitate a recession. Right now, it's very difficult to identify anything. We've already established the Fed is accommodative. They're not trying to manufacture a slowdown. We're already seeing growth rates improving and earnings improving. So it's unlikely, at least in the near term, that we're going to see a recession. So even if the stock prices are expensive, and even if we start to see a correction to try to get them maybe a little more in line, the likelihood of seeing something that is significant seems small right now, and unlikely that it will influence the market in a negative fashion overall. So I hope I've answered the first question. What's the stock market? Is the stock market expensive? Maybe it's a little bit expensive now. You can measure it a couple of different ways. It looks like the top 10 stocks are more expensive than others, but their growth rates are high. The Fed is accommodative. And right now, we're coming out of a recession, not going into a recession. So it appears that in general, the economy is accommodative, and we're likely to see some decent growth over the next few years. So the next thing that I'd like to share with you is the outlook for the US economy. So we've already established that the Fed is accommodative. What does the rest of the economy look like? Really, where are we right now? Because we still have pockets of the economy that are struggling and just barely recovering. We still have a number of people who are unemployed. We've seen the government flush the market with cash, but really, where is the US economy in this recovery, and what can we expect going forward in the near term? The first thing that I wanted to share with you is if you look at the Fed, the Federal Open Market Committee meeting minutes, you'll see the Federal Reserve meeting minutes, you'll see that the Fed is already saying they're not going to raise interest rates until we're back above 2%. Now, they said the 2% inflation rate that they're targeting is kind of a moving target now, basically saying they want to average that, which means the Fed's accommodative enough to allow inflation to rise above that figure in order to average the 2% number, which that's a good and bad thing. It means that inflation could rise to be a little bit higher than the 2% number, but it also means that the Fed is going to remain accommodative for really quite some time. And that means that there won't be a Fed manufactured recession anytime soon. And this is important because if you look right now, the stimulus packages that we have seen over the last few years have significantly changed the trajectory of the growth of the US economy. If you may remember back a couple of months ago, before the last stimulus package, the last $2 trillion that was dumped into the market, the trend line for GDP growth, we've seen this pretty consistent trend line since 2009. That trend line was out of reach for really quite some time. The red line represents the expected, what we've seen recently, and then the expected reversion to that trend line. Well, what we saw before the stimulus package, the Congressional Budget Office said that the growth rate would really never intersect the trend line in the near term. In other words, what that means is that we had it projected out to 2024, and the US economic growth had not recovered even out to 2024 prior to the last stimulus. You throw the last stimulus in there, lots of people have extra cash. They have spending capacity now that they didn't have before. And all of a sudden now you look at this trend line and it intersects the long-term growth rate since 2009. It intersects that by the end of 2021, early 2022. So this is a dramatic development. A lot of people don't realize the significance of this because we were looking at a depressed US economy for years and years to come, at least according to the Congressional Budget Office, until 2024 and beyond. And then all of a sudden we dumped $2 trillion into the economy. And now we're back on trend by the end of this year, maybe early next year, but back on that trend line growth. It's critically important, dramatic difference in what we would expect in GDP growth. Now, one thing to understand, very important, is that GDP growth does not necessarily translate directly into the stock market. You want to know that we have a healthy economy, but the stock market can become overvalued just as well. So this should lend into optimism, but it should also lend into a self-fulfilling, self-perpetuating growth in the economy that comes as a result of companies coming back, re-employing their lost employees, unemployment rates coming down, all of those factors that will contribute to continued growth in that GDP and get us back to that trend line by early 2022. This is a critically important development when it comes to how well and how healthy, frankly, the US economy is. Now, if you look, this is just another way to express that real GDP, but it's very telling. You see this growth rate, this GDP growth rate has been on a pretty consistent decline since 1984. And there are other factors that we won't get into today that contribute to that. But the one factor that's important to look is what you can see going from 2021 forward. And these are projected growth rates, of course, GDP growth rates. They're all the Congressional Budget Office forecast. But if you'll notice, 2021 through 2029, that period, those numbers look very much like the last 5 years. The averages are very close to what we've seen over the last 5 years. And so as a result, the Congressional Budget Office thinks that we're going to hit back to trend and really be back in business, if you will, for the next 5 years in almost no time flat. And it's an incredible result. You can argue that there was a lot of money spent in the last stimulus package that may have been spent irresponsibly or may have been sent to the wrong people. You can make those arguments all day long. It'd be very difficult to make the argument that it was a bad idea. Maybe the amount was too high, maybe it went to the wrong people, but the stimulus package is absolutely projected to work in terms of getting our economy back on firm footing so that we can continue to grow, get back on that trend line. We needed it. One way or the other, we needed that type of stimulus to get us back on a trend line that makes sense. And the Congressional Budget Office feels comfortable that that's exactly what's going to happen over the next few years. Now, one of the things that you can also be mindful of is this increase in money supply. So a lot of people aren't familiar with the technical term, but the government just defines different pots of money around the country in different ways. And there's something called an M2 money supply. And M2 is basically, as it says on the chart, just currency, money in your wallet, checking, savings, money market accounts, things that are 100% liquid. You can get to them today. You can go out and spend them at Walmart this afternoon if you want to. And I subscribe to an economist who saw this chart, and he's been doing this for 35, 40 years. And his comment was, this is the most remarkable chart that I have seen in my entire career. And it is remarkable for a couple of different reasons. The first one is, when you look at the M2 money supplies, that is latent demand. And what I mean by that is that you have a lot of people who took the stimulus checks, and instead of running to Walmart, they put them in their savings accounts. And we've seen all this dramatic growth in the M2 money supply. But that's in part because the economy is not fully open. And so there are things that they can't do. They can't take their cruises yet, or not in any meaningful way. It's very difficult to travel internationally now. A lot of people don't want to get on an airplane for domestic flights. We still have a lot of vaccinations that need to be applied over the next couple of months. So there's still a little bit of reservations. The restaurants are starting to pick up. Things are starting to pick up in manufacturing. So we're looking at a pot of gold when it comes to the M2 money supply and the economy. There is a lot of money in the system, and it's just waiting to go to work. Now, some of that will stay in savings, and the savings rates are astronomical right now, and people are paying down debt like they've never paid down debt before. But that still does not impact this number in a way that should tell you there's a lot of money sitting on the sideline. And when that money starts to get back to work, that's going to stimulate our economy in a way that it has likely never before in recent history, for sure, but certainly in the history of our economy. And so you look out, and why is the Congressional Budget Office so optimistic? Well, it's because there's a ton of money in the system. There's a lot of money floating around out there, and it will eventually end up in those corporations, which will increase their earnings and help support the stock prices as well. So it's a great accommodative approach from the government's perspective to put that much money in the system to make sure we have plenty of grease, if you will, on the skids to keep the economy growing the way that it should be. Now, what's the end result? Well, this is a fantastic graph to kind of show the results of what's been happening. Not just the M2 money supply, we're talking about latent demand. We're actually seeing results in the economy right now. And this is the leading economic indicators. And this is a way that we can kind of get a little bit of an advance notice as to how things are going. And what you'll see here is that we've seen the leading economic indicators all across the board increasing at a dramatic pace. It just means that when you take the collection of indicators that describe the health of the economy, they were very poor a couple of months back. Now they're starting to look very, very strong, and stronger every day. I'm going to run through just a few of these for you to kind of give you a feel for what's happening in the economy overall. You can look here at the ISM Manufacturing Index. It's actually at record pace right here at 64, much above the average of the historical periods here. Very optimistic. You look at the Purchasing Managers Index, again, record pace, very optimistic. Go forward even one more time here. Housing starts. We saw a dip during the recession. Now look where we are. We're almost above where we were in 2019. Things are so optimistic right now, even in the housing starts. Things are going great all over the economy. Housing's a great bellwether for how healthy the economy is overall. And so things are going great, even with those housing starts. So that looks really, really good. And then the last thing I'll share with you is that I love this I love this quote from The Economist on April 10th. They said, America's post-lockdown boom has begun. And they're using a number of different metrics to describe that post-lockdown boom. But one of the things is the jab and go. So people are starting to see economic activity pick up as the vaccine becomes more prevalent and more people have it and start moving around a little bit more. And then even more importantly, over here on the right, the spending spree. So I don't know if you noticed this graph, but this is just a measure from January of 2020 through now. And you can see that by the index, we saw a significant decline, 40% decline in March of last year. And you look now, where are we? We just touched the same level of credit card spending that we had pre-pandemic. So if that doesn't tell you what's going on, people have been just itching to get out, spend more money, go to the restaurants, do more travel, and they have their stimulus checks for those who have needed it. So we have this latent demand in the M2 money supply. Things are starting to pick up in the economy. A lot of the measurements of indexes that we just described a second ago are all positive. There are a lot of really healthy things going on in the economy right now. So if you think the stock market looks high, you have to say, well, why? Why is it high? Well, look at all this accommodative stuff going on. You say, well, the stock market is high because frankly, there are a lot of things pointing to a healthy economy, and maybe pricing of the stock market is not unreasonable. So those things combined give us a lot more confidence about what's going on in the economy and where we are in terms of stock market pricing. So here's the last question, and it comes up very often because everything that I have mentioned so far has been a function of an accommodative Fed. So the Fed has helped precipitated an accommodative environment. The government's dumped a bunch of money into people's checking accounts, and all of a sudden we have all this new cash lying around. Now we've taken on an unprecedented amount of federal debt. So the question is, maybe it looks good now, Scott, but what's going to happen when this debt really gets a toehold and we start to see inflation rise as the result of the debt? Well, as you know, a high debt to GDP ratio is something that we've tried to avoid for generations. It's a very simple concept. If you're an individual and you have a high debt to earnings ratio, if it's so high, maybe like we run, debt to GDP ratios above 100%. Japan, for example, has run well over 100% debt to GDP ratio. Well, if we had a debt to income ratio as an individual that was above 100%, we'd be bankrupt in a week. So how does that apply in a governmental setting? Is it the same thing? Should we see inflation because we're expecting to see this debt to GDP ratio increase above 100%? Let me give you just a little perspective on that. The first thing is the chairman of the Federal Reserve, Jay Powell, says he's not really concerned about inflation. The best view that he says is that inflation will be neither particularly large nor persistent. Well, how can he come to that conclusion? He doesn't really see inflation as being a problem in the US economy anytime soon. So you're talking about the smartest economists in the world driving the recommendations for the Federal Reserve. And they're saying, consensus expectation is that inflation will not be a problem anytime in the near term. So what if we look out just a little bit and think about what has happened in the past and how that has impacted our inflation rate? Well, as you may know, target inflation rate is 2%. So at a 2% inflation rate, the Fed feels comfortable that we're growing at a reasonable pace. Prices are growing at a pace that they should be growing, and we don't risk deflation. So deflation, while it sounds like a good idea, is actually terrible for the economy. It's much worse than higher inflation. Deflation is what you want to avoid. So when inflation gets too low, you worry that you're tempted to slip out into deflation, and that's a terrible situation to be in. So they want to be at about a 2% inflation rate. Well, with everything that they've tried to do over the last decade, they have been unable to get that inflation rate anywhere near 2%. If you see this one little section in 2011, it jumped up to right at 2%. And every other period beyond that, it has been below that 2% trend line, not only below, but sometimes way below that 2% trend line. And it's more like 1.5% over that time frame. So first of all, they're starting at a depressed state. They're saying, well, we've done all of we've pulled all the levers and we've pushed all the buttons and we've not been able to get it to 2%. So what are we concerned about inflation rising above 2%? That's the first thing. Second thing is that when they look at it, they have a more accommodative stance. And I mentioned this earlier. They're willing to let the inflation rate rise above 2%, not a target of 2%, but an average of 2%. And of course, if we've been trending around 1.5, that means the average can just shoot right past 2, and we don't have to be especially concerned about dialing it back immediately and potentially forcing the US economy into recession again. So what they've decided to do is let it slip on past 2%, And then we'll let it settle back to 2%, not try to target right on 2% and dial back as we get closer to that line. That's an important distinction because that means the Fed can be more accommodative for longer, therefore stimulating the economy. So do I expect an increase in inflation? Well, yeah, the Fed's trying to increase inflation. They have been for years and years. I think right now we're in a position where there's a lot of money in the system. Supply is a little bit diminished. We'll probably see a little bit of a demand drive right now with inflation. And certainly over the next few months, we think inflation will rise. Will it rise to a dramatic rate? No. In fact, the Fed's actually describing it, and many of the economists are calling it reflation, which is a new, when you're an economist, you can make words up. So this is one of those made up words. So we're going to reflate the economy. And basically what they're saying is that there are assets and things that we buy and so forth every day, which have been depressed. We haven't been able to get out. And I think about airline prices. I'm stunned at the airline prices right now. It's still so cheap to fly. And those prices are well below where they normally are. So what we'll see is as the economy reopens, things start to get back on track. We'll see those prices reflate back to where they've been in the past. And that's perfectly okay. That's what we expect to see. The year over year inflation rates will be high because they're down now. I mean, we saw inflation rates to Jackson Hole, Wyoming from Pensacola for $182. Flights from Pensacola to Jackson Hole for $182 round trip. That kind of stuff is just unusual. And so we have a number of things that are in the system and they're depressed that way. We'll see reflation to those prices. And that's exactly what the Fed's looking for. So we've got an accommodated Fed. We'll see the inflation rate go up just a little bit and it'll wrap around that 2% line. Eventually, that's their target. Now, here's the kicker. And this is the one that we talk about all the time. The question is, with all this debt, the government has taken on all this debt, will it not destroy our economy? And the best answer from a modern economic theory perspective is that there isn't a lot of evidence that debt at these levels has a dramatic negative impact on the economies. And the reason that I can say that is you can look at the other developed economies around the world and see that many of these economies have been running these debt to GDP ratios much higher. You look at France and they've been in the 80–90% range. Germany's particularly astute and they're very careful with their finances. They do not take on a lot of debt and they do that intentionally. The UK has, again, been running in the 80% range. They're expected to go up. US has been in that 80% range, expected to go up above 100%. But the one in the center of the screen is the one that's the most compelling, and that's Japan. And as you can see, this is going back to 2015. Their debt to GDP ratio has been 140% or more of their the debt of the GDP. So 140% debt to GDP ratio or more since 2015. And as you know, Japan's economy is much like ours, a developed economy. And you may say, well, gosh, their stock market hasn't done anything. Their economy really hasn't grown over the last few years. I mean, isn't that evidence that you shouldn't run so much debt? Well, the answer to that question is no. Their economy has not grown, not because of the debt, but more because of their demographics. And so there are a lot of explanations around that. But ultimately, economists are mixed, but not terribly mixed about the bit of unknown around a high debt to GDP ratio. You'll hear people say all the time, we should not run those high debt to GDP ratios. And when you think about how low the interest rates are, you're talking about a government that's borrowing at historically low rates. Well, you could make the argument that they're doing the same thing companies are doing. They're recapitalizing with very low interest rates, and they're putting the money back in the economy, and the economy is expected to grow. And so maybe we'll get some multiples of return on top of that cost of capital. And there's an argument for that. But economists are especially in modern economic theory, they're very specific about the way this works long term. Let me give you just a quick summary here. Modern monetary theory says federal governments can and should run large budget deficits in order to achieve full employment. So not only, it seems counterintuitive on an individual level. Again, You run large budget deficits at your house, and somebody's going to be pulling you out of jail because you're not paying your bills. That's just not the way an individual's household works. And we tend to project that on governments. But modern monetary theory says that's not the case for governments. Governments are supposed to run these deficits, and they should in order to achieve their full employment. The next thing is federal government deficits is too small if there is any unemployment. And that means that there's basically underutilized resources. In order to leverage those resources, we have to make sure that we run the deficits to get the unemployment rates down. And there's no well-defined limit on how much that borrowing could be, unless inflation starts to heat up. And then at that point, you start to intervene. But here's the kicker. Here's the most important factor. And actually, I guess it's another talking point for the Biden administration tax increases we expect later this year. But the first thing is inflation can be taxed away. Targeted taxes can reduce excess demand. Reduction of excess demand softens inflation. And so modern monetary theory suggests that we can run higher deficits, we can run a higher debt, and as long as inflation is in check, we don't have anything to worry about. And if inflation starts to get out of hand, we can tax our way out of it and basically both reduce the deficit, reduce the debt, and stifle the inflation rate a little bit. So the argument here is that, first of all, the Fed is not concerned about inflation. Should they be? Well, I guess we'll see in a few years. But right now, when they consider modern monetary theory, the need for reflation all around the economy, the fact that we're starting in the hole anyway right now, they're very not concerned at all about inflation arising right now. And that's why Jay Powell can say, I'm not thinking about raising rates. We're not even thinking about raising rates. He's not going to raise rates because there's nothing to stifle at the moment. And then you factor that in with what's happening in the economy, and it looks like that inflation will probably be in check for a number of years to come. Biden raises the tax rates later this year, and we already are taking, evasive action, if you will, on inflation rates really running out of control. So I think I'm in time, and I really appreciate the time that you've spent with me. In summary, it boils down to three things. Is the stock market overpriced? Are we destined to see a correction? Is it going to fall 20%? I hope I've made the argument that, first of all, if you look at it on the surface, the stock market is a little bit overpriced. But even if you look at the trend line, it's not a lot overpriced. It hasn't been that way for very long. We've had just a few stocks that are really driving a lot of that high PE ratio. And so, with earnings growing the way they are and the pent-up demand that we expect to see, there's an argument that really we can probably sustain these prices. Maybe we'll see a correction. We always do. I mean, we see them frequently anyway, but something around 10% is not unreasonable. And maybe it'll reprice to 10%. And that would be a good correction. We'll probably see it in the growth stocks more than we would see it in the value stocks, but that's nothing to worry about. We see that all the time. So I would make the argument that, it's a little overvalued, but not terribly overvalued. It doesn't change our perspective on the portfolio. We still think, relatively speaking, the US is more expensive than our overseas stocks. And so we'll still have an emphasis on overseas stocks. We're just not really worried that the market is in a crazy 1999 kind of bubble that we expect to burst and see, significant declines, year over year declines, not in this environment and not without a recession to accompany it. So the second question then is, how is the health of the U.S. economy? I think I've made the argument that the U.S. economy is in pretty good shape. We're starting to see earnings grow. We've already made the argument that the Fed is accommodative and expects to be that way for some time. And if you look at the forward indicators, even the current indicators, when you look at the Purchasing Managers Index and things of that nature, we're looking at record numbers on those indices. And as a result, we think the economy is in a relatively healthy position. We'll see continued expansion. We continue to open up the economy as vaccinations become more prevalent, and we have a lot of cash in the system to kind of help that growth. So I think the U.S. economy is in a pretty good place. We'll start to see that growth. It probably be reflected in the stock market. I think a lot of that's priced in, which, by the way, I think most of us think that corporate tax rates will go up, which is another question that comes up often. What happens to the stock market when corporate tax rates go up? Well, I think most everybody on this call believes that corporate tax rates are going up. I think when Biden was elected, most everybody thought corporate tax rates would go up. And so I believe it's probably priced into the market. Maybe we see a little volatility along the way. I think most people believe that. And if they believe it, it'll be priced in. It might be an upside surprise if it's not 28% at the end of the year, but we'll see what happens on that. And then the last question is, do we expect inflation? The Fed doesn't expect inflation, not anytime soon. And they have a very accommodative approach to allowing inflation to grow a little bit. The big risk with inflation, of course, is the Fed has to intervene with raising short-term interest rates, run the risk of inverting the yield curve and causing the economy to freeze up. And so is the likelihood of that very high? No, not very high at all, especially not right now. We may see something like that end of 22, 23. I think the Fed's really projecting it way years out from now before we really even see anything like that. So I think the risk of an increase, a slight increase in inflation is very high. I think we'll see some inflation as we get reflation in different parts of the economy. I think we'll see that for sure. But what about runaway inflation? There just really isn't a lot of support for it, especially when you look at modern monetary theory, just not a lot of support for runaway inflation anytime soon. So I hope those concepts give you at least a little bit of help around what's happening in the economy, what's happening in the stock market, if we should expect, the other shoe to drop. Frankly, things are okay. And it doesn't mean we won't see volatility. It doesn't mean we won't see a correction, and we're bound to see a surprise. We always do. And whenever those surprises come, of course, the market reacts. But we have pulled away from the US because the prices are a little on the high side. We're not out of the US, but we pulled away a little bit. And by just pulling away, we've mitigated some of that downside risk in the portfolio. And we're still in the US market because frankly, things look pretty good around the US right now on a lot of fronts. And who knows, maybe we'll catch the earnings up and the valuations will start to come down and we'll start to see a broader participation in the market which we're already seeing of those companies that suffered over the last 12, 14 months or so. And they'll start to pick up and maybe we see a little more growth along the way. Wouldn't surprise me at all if we did. So thank you very much for the time that you've spent with me today. I appreciate the opportunity to share this with you and hope that you've gotten a little something out of it. Don't hesitate to email me or give me a call if you have any questions about anything that you've heard. If you see any of the slides you'd like to discuss further, I'm happy to talk with you. And if I don't talk with you, I hope you have a great weekend. And I hope you let me know if there's anything that we can do to help you in the future. Take care.